Business finance often sounds complicated because people hear words like revenue, expenses, margins, cash flow, assets, liabilities, forecasting, and working capital all at once. But you simply need to organize the money into a few clear categories. In this video, we will explain 6 major categories to make business finance less complicated with practical examples. Number 1. Money coming in. The easiest place to start with business finance is money coming into the business. Before worrying about complicated reports, ask one basic question: where does the company's money come from? To understand this, imagine Amazon and all the different ways customers and businesses interact with the company. When a customer purchases a product through Amazon, money enters the overall Amazon business ecosystem, but product sales are only one part of the picture. Amazon also operates subscription services, advertising services, cloud computing services, seller services, and several other business activities that can generate revenue. This immediately teaches us an important lesson. A company can have multiple revenue streams. Instead of looking at one giant revenue number, business owners should understand which activities are actually producing that revenue. This makes it much easier to see what is driving the business. Imagine a simplified Amazon-style business with 3 revenue sources: product sales, subscriptions, and services. Product sales might generate the largest amount of revenue, while subscriptions provide more predictable recurring revenue, and services may generate revenue from business customers. Each source brings money in differently. Now apply this idea to a small business. Imagine an electronics store. It might earn money from selling laptops, repairing devices, selling accessories, and providing annual maintenance plans. Looking only at total sales hides useful information. Separating those revenue streams tells the owner exactly where the money is coming from. Suppose laptop sales are increasing, but repair revenue is falling. The overall revenue number might still look healthy, but the business is changing underneath that number. By tracking each source separately, the owner can understand which part of the business is growing and which part needs attention. There is another important distinction. Revenue does not always mean cash has already reached the bank account. A business can complete a sale today, but allow the customer to pay later. The sale may count as revenue, even though the business is still waiting for the actual cash. For example, imagine a business provides a service worth $1,000 to another company and sends an invoice allowing payment later. The business has earned revenue, but it does not yet have that $1,000 available to pay employees, suppliers, rent, or other expenses. This is why understanding money coming in requires more than watching the bank balance. A business owner should know how much revenue is being generated, where that revenue comes from, how much has actually been collected, and how much customers still owe. The Amazon example makes the first part of business finance simple. Do not begin with dozens of financial ratios. Begin by mapping the paths through which money enters the business. Once you understand those paths, revenue becomes much easier to track, compare, and manage. Number 2, money going out. Once you understand where money comes from, the next question is equally simple. Where does the money go? To understand this side of business finance, think about Apple. Selling an iPhone creates revenue, but producing and supporting that sale also requires the company to spend money. Before a device reaches a customer, many different costs are involved. Products need components, manufacturing, transportation, packaging, storage, employees, technology, retail operations, marketing, customer support, and other resources. Revenue may enter through a sale, but expenses are constantly moving money in the opposite direction. This gives us the basic financial picture. Money comes in through business activities, and money goes out to support those activities. A business becomes easier to understand when expenses are not treated as one giant number, but are separated into meaningful categories. Some expenses are closely connected to producing or delivering what the company sells. In a simplified Apple example, manufacturing components and assembling devices would be connected to products. If more products are produced and sold, many of these costs can increase with business activity. Other expenses support the broader organization. Offices, certain employee salaries, software systems, professional services, administration, and other operating costs may continue even when sales temporarily change. Understanding this difference helps owners see which costs move with activity and which costs are harder to reduce quickly. Imagine a smaller company selling its own electronic accessories. It generates $50,000 in monthly sales. The owner might initially feel successful because $50,000 sounds impressive. But that number tells us almost nothing until we understand what it costs to generate those sales. The company may need to pay suppliers for products, employees for their work, a warehouse for storage, shipping companies for deliveries, advertising platforms for customer acquisition, and software providers for operations. Every dollar leaving the company reduces the amount available for other purposes. This is where many owners make business finance unnecessarily difficult. They look at dozens of individual transactions without organizing them. A simpler method is to group spending into major categories, such as products, employees, facilities, marketing, technology, transportation, and administration. Now imagine the accessory business notices that sales increased, but marketing and shipping expenses increased even faster. Revenue growth looks positive at first, but the cost structure tells a different story. The company is working harder and selling more without necessarily creating proportionally more financial value. That is why expense control does not simply mean spending less. Apple cannot eliminate product development, manufacturing, employees, or customer support just to reduce costs. Businesses need to distinguish between spending that creates value and spending that produces little useful return. A growing company may intentionally increase certain expenses when those investments support future revenue. Hiring capable employees, improving technology, developing better products, or expanding distribution can make sense. The financial question is whether the expected business value justifies the money being spent. So the Apple example gives us the second simple rule. After mapping every major path through which money enters the company, map the major paths through which money leaves it. You cannot properly understand business performance until both sides are visible. Number 3, understanding profit. Now we can connect the first two categories. Money comes in and money goes out. What remains, after accounting for the relevant costs, leads us toward profit. Microsoft provides an easy example because it sells products and services while also operating large technology infrastructure and employing a massive workforce. Imagine Microsoft earns revenue from software subscriptions, cloud services, gaming, devices, and other business activities. Those activities generate large amounts of revenue, but revenue alone does not tell us how much financial benefit the company ultimately keeps after covering its costs and expenses. This is why revenue and profit should never be treated as the same thing. A company can generate enormous sales and still have weak profitability if the cost of generating those sales is too high. Another company can generate less revenue while operating efficiently and keeping a healthier portion of each revenue dollar. Consider a simplified example. Imagine a software company generates $100,000 in revenue. If providing its services and running the company ultimately requires $90,000 of costs and expenses, only $10,000 remains before considering any additional items relevant to the final calculation. Now imagine another software company also generates $100,000 in revenue, but manages its operations with $70,000 in comparable costs and expenses. $30,000 remains. Both companies produce the same revenue, but their financial outcomes are dramatically different. This is where profit margin becomes useful. Instead of asking only how much did we sell, the owner asks how much of our revenue are we actually keeping. That question can reveal financial strength that revenue alone cannot show. Microsoft also helps explain why different types of revenue can produce different economics. A software subscription, cloud service, gaming product, and physical device do not necessarily carry the same costs. Some business activities may contribute stronger margins than others. A small business should think the same way. Imagine a company offers website development, monthly maintenance, and consulting. Website projects may bring in the most revenue, but monthly maintenance could provide consistent income with relatively efficient ongoing delivery. Consulting might produce another completely different margin. If the owner only watches total revenue, these differences remain hidden. But when revenue and related costs are compared by product or service, the owner can identify which activities contribute most effectively to the company's financial performance. Profit also gives the business options. A profitable company can potentially build cash reserves, repay debt, hire employees, invest in equipment, improve products, expand marketing, or fund future growth. Without enough profit, many of those decisions eventually become harder to sustain. However, profit does not automatically mean the same amount of cash is sitting in the bank. A business might report a profit while still waiting for customers to pay invoices, holding money in inventory, or paying obligations at different times. That leads directly to the next major financial concept, cash flow. So the Microsoft example simplifies the third category into one question. After understanding what the business earns and what it spends, ask how much financial value remains. Revenue shows the size of business activity. Profit helps show whether that activity is financially worthwhile. At this point, business finance should already look much simpler. First, identify where money comes from. Second, identify where money goes. Third, determine what the business keeps. These three ideas create the foundation for understanding the next three areas: cash flow, financial position, and financial decision-making. Number 4, managing cash flow. Now we reach one of the most important parts of business finance, cash flow. Profit tells you whether the business is financially productive, but cash flow tells you whether the business has enough actual money available at the right time. Walmart provides a simple example for understanding this difference. Imagine what happens when Walmart sells groceries, electronics, clothing, or household products. Customers usually pay when they make their purchases. Cash enters the business quickly. But before those products could be sold, Walmart had to purchase inventory and manage many other operating costs. This creates a cycle. Walmart spends money to obtain inventory. The inventory sits in stores or distribution centers. Customers purchase those products. Cash is collected. Then Walmart needs more inventory to replace what was sold, so money moves out again and the cycle continues. The speed of this cycle matters. Imagine a store spends $10,000 buying inventory. If that inventory sells quickly, the money can return to the business relatively fast. The store can then use that cash to purchase more inventory and continue operating. But imagine the same $10,000 is spent on products that customers do not want. Those products may remain on shelves for months. The business technically owns valuable inventory, but the money used to purchase it is temporarily trapped inside products instead of being available as cash. This is why inventory management and cash flow are closely connected. A retailer does not simply want shelves full of products. It wants the right products moving through the business efficiently. Faster inventory movement can help cash return to the company sooner. Payment timing creates another important cash flow issue. Businesses receive money and pay money on different schedules. A company might collect cash from customers today while paying certain suppliers later. Another business might pay its expenses today, but wait weeks for customers to pay invoices. Imagine a consulting company completes $20,000 of work this month. On paper, the business may have generated strong revenue. But if customers will not pay until next month while payroll and rent are due this week, the company can experience cash pressure despite having successful sales. This explains why profitable businesses can still struggle financially. Profit measures financial performance over a period. Cash flow tracks the actual movement and timing of money. A business needs enough available cash to continue operating while waiting for future collections. The Walmart example gives us a simple cash flow question. How quickly does money leave the business, move through operations, and return as available cash? The longer money remains trapped in inventory or unpaid customer balances, the more working capital the business may need. For a small business owner, managing cash flow can begin with a basic routine. Track expected customer collections, upcoming supplier payments, payroll, rent, taxes, debt payments, and other major obligations. Then compare when cash is expected to arrive with when cash needs to leave. Cash flow becomes much less complicated when you stop treating it as an accounting mystery. Think of it as timing. Money can be coming, but if it arrives after an important bill is due, the business still has a problem. Number 5. What the business owns and owes. After understanding revenue, expenses, profit, and cash flow, we can look at the financial position of the business. This sounds complicated until you reduce it to two basic questions. What does the business own, and what does the business owe? McDonald's provides an easy way to understand this concept. A large restaurant business can have many valuable resources connected to its operations. Depending on the business structure, these can include cash, equipment, property interests, technology, receivables, and other resources. In accounting, resources with economic value that meet the relevant requirements are generally called assets. Imagine a simplified restaurant that owns kitchen equipment worth $30,000, has $15,000 in cash, and has other qualifying business resources worth $5,000. Together, these assets help the restaurant operate and generate revenue. But knowing what the restaurant owns is only half of the financial picture. The restaurant may also owe money. It might have a bank loan, unpaid supplier bills, equipment financing, taxes payable, or other financial obligations. These obligations are generally called liabilities. Suppose our simplified restaurant has $50,000 in assets, but also owes $20,000 to lenders and suppliers. You cannot properly evaluate its financial position by looking only at the $50,000 of assets. You also need to consider the $20,000 it owes. The difference brings us toward owner's equity. In very simple terms, the accounting equation connects assets, liabilities, and equity. If a business has more assets than liabilities, the remaining accounting interest belongs to the owners, although real financial statements can contain additional details. Think about McDonald's again. Seeing restaurants, equipment, technology, and other resources might make the business appear financially powerful. But a complete financial picture also requires understanding obligations. Assets show resources controlled by the business, while liabilities show financial claims and obligations against those resources. This matters for small businesses too. Imagine two restaurant owners each have $100,000 of business assets. The first business has $10,000 in liabilities. The second has $90,000 in liabilities. Their assets look identical, but their financial positions are clearly very different. Debt itself is not automatically bad. A business might borrow money to purchase productive equipment, open a location, improve operations, or support an investment expected to create future value. The important question is whether the business can comfortably manage the obligation and generate enough value from the decision. Business owners should therefore keep a clear picture of major assets and liabilities. Know how much cash the company has, what customers owe, what inventory or equipment it controls, how much debt remains, and which bills or other obligations still need to be paid. This is essentially what the balance sheet helps organize. You do not need to make it intimidating. Think of it as a financial snapshot showing what the business has, what it owes, and the accounting value remaining for the owners at a particular point in time. So the McDonald's example simplifies this category into three connected ideas: assets, liabilities, and equity. Once you understand those three pieces, the financial position of a business becomes much easier to visualize. Number 6. Financial planning and decisions. Now we can connect everything. Nike can sell products, generate revenue, pay expenses, produce profit, manage cash, own valuable assets, and carry financial obligations. But business finance becomes truly useful when management uses all of that information to make better decisions about the future. Imagine Nike is considering launching a major new product line. The financial question is not simply whether the idea sounds exciting. Management needs to estimate potential demand, pricing, production costs, marketing expenses, inventory requirements, expected profitability, cash requirements, and the financial risks involved. This is financial planning in practical terms. Before committing significant resources, a business tries to understand what could happen financially. It creates expectations, compares possible outcomes, and determines whether the opportunity makes sense based on available information. A small business can use exactly the same logic. Imagine a local clothing company wants to introduce a new line of athletic wear. The owner estimates that launching the collection will require $20,000 for inventory, marketing, packaging, photography, and other initial costs. Instead of spending immediately, the owner builds a simple forecast. How many products need to sell? What price can customers realistically pay? How much will each product cost? How long could the inventory take to sell? How much cash should remain available for normal operations? These questions turn an emotional business decision into a financial decision. The owner still cannot predict the future perfectly, but planning reduces the chance of committing money without understanding the potential consequences. Budgeting is another part of this process. A budget gives money a purpose before it is spent. The business can decide how much it expects to spend on employees, inventory, marketing, technology, facilities, debt payments, and other priorities during a specific period. Forecasting goes one step further by continuously updating expectations as conditions change. If sales are weaker than expected, expenses rise, or customer demand shifts, the business can adjust its financial expectations instead of continuing to operate according to an outdated plan. Nike also helps demonstrate why financial decisions should connect back to the entire business. A new product could increase revenue, but it could also increase inventory, marketing expenses, supplier commitments, and cash requirements. Every major decision can affect several financial categories at the same time. That is why business owners should not evaluate decisions using revenue alone. Ask what happens to expenses. Ask what happens to profit. Ask how much cash is required. Ask whether new assets or liabilities will be created. Then ask whether the expected return justifies the financial risk. This creates a much simpler way to think about business finance. Numbers are not collected just to create reports. They exist to help management decide when to spend, when to save, when to hire, when to borrow, when to invest, when to expand, and sometimes when to wait. You do not need a giant corporation's finance department to use this approach. Even a small business can review a few important numbers regularly, compare actual results with expectations, update its forecast, and make the next decision based on evidence instead of assumptions. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching.